Good afternoon. For this session, we're pleased to have Amit Bori, CEO and co-founder of the Global Impact Investing Network, who will kick off this session, with Amanda Kaiser, Director of Impact at Nuveen, Neil Gregory, Chief Thought Leadership Officer at the International Finance Corporation, and Veronica Giusti-Keller, Senior Impact and ESG Manager at Blue Orchard. Together, they will examine best practices and challenges in sourcing, reporting, and communicating impact measurement data and outcomes. They'll also address the importance of capturing this data in an aligned, comparable, and standardized format. Look at various tools that investors can utilize to report on impact, and do a deep dive on industry initiatives that are driving progress. Now over to you, Amit.
Great, thank you for that kind introduction, and thank you to Ceres for hosting this important event and this important conversation, really trying to take stock of the state of impact measurement and management. We at the Global Impact Investing Network are incredibly interested in this issue. We think it's absolutely essential, not just for the impact investing community or the ESG investment community, but actually for the investment market broadly. And at its essence, it gets to how do we actually understand the impact that investments are having? Whether they be positive impacts, negative impacts, and eventually a more holistic view on how investments and companies interact with a much broader array of stakeholders than just looking at their financial performance. We have an incredible panel lined up, and we'll dive right in with questions. And I would really want to just encourage discussion on the live chat. And so please feel free to feed in your thoughts and reflections on this topic. But to start off, I'll begin with Neil. And Neil, we've of course been partners between the IFC and the GIN for some time. And a couple of years ago, in 2019, the IFC led an effort to launch operating principles for impact management. Now, could you talk a little bit about the principles, and also increasingly, I think one of the things that's interesting is about the intelligence and what we're learning from the signatories. And of course, you just had the first round of disclosures, and I'd love to hear a little bit more about what are the patterns you're seeing and what that says about the state of impact measurement and management right now.
Thanks, Amit. And the starting point for the operating principles for impact management was really what we see in the market, which is that more and more investors want to find opportunities to invest for impact, but they also want to be sure that where they're placing their money is going to be invested for impact in a disciplined way, and they want to avoid any kind of impact washing. And so the operating principles basically spell out the steps that you need to take to integrate an impact objective alongside a financial objective at all stages of the investment cycle. And importantly, they also require institutions and funds following the principles to disclose how their impact management system actually works and does implement the other principles, and from time to time to have their system independently verified to make sure that it is actually being implemented in the way that they claim it is in the disclosure statement. And the reason for asking signatories to do this is really to bring a level of transparency and credibility to the market, which is what the asset owners are looking for, to make investors comfortable in putting their money into impact funds and into institutions that will manage their money for impact in a disciplined, incredible way. And so nearly 2 years after the start, we now have 115 funds and institutions that are following the principles, and more than 80 of them have already published their first disclosure statements. They're all available on the web for anybody to read, and I encourage you to do so if you're interested in finding out more about how different institutions are putting impact management and measurement into place. And when we reviewed the first batch of these disclosures in the summer, we were encouraged to see that there is actually quite a lot of convergence around the way that different funds and institutions are managing impact. I think we see convergence around common use of ESG screening standards, like the IFC performance standards and other standard approaches to ESG. Also encouraged to see that the majority of the disclosures show that people are using the HIPSO or IRIS Plus indicator sets to actually measure and report on their impact. And that's something that we hear a lot from both the asset managers and the asset owners as well, that if we can converge towards common ways to measure and report on our impact, that will make it easier for everybody in the market. as well. So just this month, we actually, together with the GIN, have launched the first of a set of joint impact indicators, starting with the important impact themes of climate, gender, and jobs, which we hope many impact investors will coalesce behind. So we're really using a common basis to measure and report on that impact.
Great, thank you. And I think that's one of the big trends that we're observing is a proliferation of approaches a couple of years ago, and now increasingly a convergence around common approaches, common standards, and of course, common measures. Now, Amanda, I'd love to hear about your perspective, representing a mainstream global diversified asset manager. How does Nuveen approach impact measurement across asset classes, and why is this a growing priority for the firm?
Exactly what you said. We are thinking about impact across our portfolio. Nuveen is a mainstream investor. We manage over $1.2 trillion across asset classes. And so we are thinking about how do we take things like the IFC's operating principles for impact, and how do we actually embed them, taking kind of an asset class approach where we may need to have specific tailored strategies that match actually with the capital that we're putting into place. In addition to being partners with the IFC and other organizations around these common standards, we also have kind of three core characteristics that actually underline all of our impact investing and all of our impact management and measurement processes. The first is really a commitment to measuring direct and measurable outcomes. So for our portfolios, making sure that we can actually do that measurement directly on what is the impact of our investments. The second is thinking about impact in a comprehensive way. So what is a positive impact and potentially negative impact that our investments might be having? How do we weigh those two things? And then how do we try to minimize the negative externalities while also scaling the positive? And the third is around transparency. So making sure that we're reporting out on our impact investing portfolios consistently. So we are one of the first in the fixed income market to put out an impact report for our impact investing core impact bond portfolio. Last year, we launched our private markets impact investing report that included 10 years of data on our private markets portfolio. And we're excited to continue to expand our reporting capabilities for clients. I think that actually leads into the second part of your question, which is about why is this such a big part of Nuveen's priorities moving forward. First, it is actually part of our core DNA. Nuveen is a TIA company, which serves teachers and healthcare workers and government employees to retire with real dignity and financial security. So purpose is core to what we do as we think about serving our largest client, which is our parent. And second, it's continuing to be a growing opportunity, and we see a demand in the market, both from our existing clients, but also prospective clients. So we think impact is here to stay, and the opportunities are growing.
Great, thank you. And I'd like to get your perspective as well, Veronica. Could you share a bit about Blue Orchard's approach to impact measurement? Kind of, what are those approaches that are in common, and what's different, especially given your focus on impact investing as an asset manager?
Oh, thank you. Thank you for the question. Well, Blue Orchard has been a global impact investment manager for almost 20 years. And impact investing is really the core of our business. This is what we do since the beginning. And so we started implementing impact measurement practices a very long time ago. So we have benefited from our long experience and various trials and errors and different iterations of different measurement frameworks. And the framework we use now is what we call it the B-Impact framework. And it is integrated in all of our investment processes. And it's really based on three pillars. So you have first an ESG assessment based on the investee. Second, you have an impact assessment that is really based on the investment that is made, and it's related to the impact intent. And then the third pillar is it's an SDG mapping and aimed really at providing transparency to our key stakeholders. So on the first pillar, on the ESG assessment, we developed an in-house tool that we call the Spirit ESG. And it includes an assessment of various ESG factors that vary depending on the industry. And these factors, I mean, we include material factors as per best market standards. We use UNPRI, SASB, among others. And also our own experience, because we work in less developed countries. And so somehow we need to sometimes adapt and also incorporate new factors that perhaps mainstream investors don't really have to care about. And with this scorecard, we come up with an ESG rating, and this ESG rating is key and is used for origination and is used for monitoring purposes. And then perhaps the last thing to mention on our ESG assessment that for us, part of our impact commitment is engagement. So this Spirit ESG tool also allows us to identify perhaps certain gaps that could help us engage with our investees. Then the second pillar that I mentioned is the impact one, and is this the impact assessment scorecard, also called Spirit Impact, and this was built following the impact management project framework, the IMP framework, that has 5 dimensions. So they look at the what, to somehow really define what is the investment intent, and also then the how much and the who. And here we have to, where we define what are the impact KPIs, and where we can also then measure and quantify these impacts and monitor them over time. And for this one, we use IRIS, for example, and other tools to have, again, some standard KPIs that can be easily understood by stakeholders. And then we also follow the other dimensions, the contribution, and then also we somehow try to measure as well what is the risk of not achieving that intended impact. And then the last pillar, as I said, was the SDG mapping. So we have it's important for us to provide transparency. And we somehow, our approach is to do it on a bottom-up way, so that we measure, since we monitor individual KPIs for each investment, we have mapped them to the UN SDG targets, not on the 17, but on the actual targets that are 170 and I think 250 indicators. So what we try to do is to quantify in this way the contribution that we are doing. And again, transparency is key for us. I mean, why this is important for us is that we think that it will, having a strong impact measurement system is really key to catalyze more private assets into the impact asset class. And the IFC principles that have been mentioned, that were developed by IFC, we think are a crucial step for this. The Blue Orchard's flagship fund is the Blue Orchard Microfinance Fund, was one of the first signatories for the operating principles for impact management. And last year we received an independent verification that you can see on our website. So we think really that these principles will help improve transparency in the industry.
Wonderful. Thank you, Veronica. And I want to build on that point you brought up around quantification. And you referred to some of the work that we do at IRIS Plus, that with all of the panelists, actually. Neil spoke about this as well before. And one of the things that's so important is when we think about impact, there's certainly dimensions that we can actually quantify. There are also qualitative measurements, which also lend themselves potentially to being more subjective. Amanda, I'd love to hear from your perspective, when it comes to measuring the social impact investments, how you tackle this challenge, and what are the tools and resources that have been most helpful for you to think about the different dimensions of impact?
Yeah, it's a great question, and I think this challenge of can we quantify social impact has been sort of plaguing folks for a long time. But I actually think the last 5 years there's been a lot of good work. I think obviously the GIN's been leading that. I think that the work that the Impact Management Project, IMP, has done has been great in that, because what it's done through those 5 dimensions is said, we need to expand the lens at which we think about impact. I think when we think about environmental measures, right, if we think about, measuring the environmental impact, we have really specific quantifiable measures around carbon, around wastewater. And when we ask ourselves questions around like, what does it mean to support inclusive growth, or what does it mean to create good jobs? I actually think there are quantifiable measures. It just may mean that we have to look at 2 or 3 data points related to that idea so that we get a full context of that. And so we have been adopting, you know, again, things like IRIS, IRIS Plus, things like IMP that give us those multidimensional view of a particular aspect, and really look for measures that we then can scale. Again, given our size, given our breadth and diversity of asset classes, we are looking for those quantifiable measures that we can scale really across the platform.
Great. I want to turn to Neil. Thank you for that. Those remarks, Amanda. And for Neil, from your perspective, as you engage other asset owners, of course, as an asset owner yourself, can you talk a little bit about how you see the appetite for impact reporting evolve? What are some of the dimensions that have kind of, we've certainly from the GIN's perspective seen a lot more interest from mainstream actors who are really thinking about impact data and impact performance. But one of the questions that comes up is, how do you think about impact measurement across private and public markets? And can you talk a little bit about how that's come up in some of your work?
Sure. So, as you say, we engage a lot with asset owners. We have co-investment platforms for both debt and equity, where we actually have insurance companies and pension funds and sovereign wealth funds co-investing with us. So we have a very regular dialogue with them and understand what they're looking for making these investments. I mean, firstly, of course, they all have their fiduciary responsibilities. So they look for good data and understanding of the risk return profile on the financial side. And a few years ago, that was really where the focus of their attention was. But I would say we've really noticed a shift in the dialogue over the past few years, and we get more and more questions. And when asset owners are doing their due diligence, they want to increasingly look at our impact management system and look at the kind of information that it gives. And I think, at the forefront of their interest in having good measurements has been the heightened focus on climate impacts. I think all investors and increased pressure from their various stakeholders to disclose what their climate impacts are, both positive and negative. And so I think that there's a very sharp focus on that. But I also think since 2015, the past 6 years, the Sustainable Development Goals have really put a wider range of impacts on the agenda of asset owners. And whether we're talking to family offices, to endowments, sovereign wealth funds, or to pension funds, I think they all increasingly use the Sustainable Development Goals as a starting point for thinking about what kind of contribution they can make to having positive impact. So I think it is important that we have metrics that speak to the different Sustainable Development Goals. And great admiration, Veronica, if you've managed to link all of your impacts to that very detailed level of specific indicators against the SDGs. I think that's great work, and that's exactly what asset owners are looking for. And I think what you've seen is that the earliest areas where impact investors were able to really get traction and show good financial returns and very clear metrics of impact were around financial inclusion, a lot of investing in microfinance, and more recently energy efficiency and green energy, where you have very clear and measured climate impacts. I think what you've seen over the last year is an increased attention to inequality and other types of impact, particularly in the US, which are harder to measure. And I think Amanda spoke to that point as well. But I do think that we need to continue to push to find ways to measure progress. And for us in our own impact management system, what that means is not just measuring what the impact is, but putting that impact into the context of what is the social or environmental challenge that you're trying to address. So in our own measurement system, we actually both measure the impact of our investments, but we also put work into measuring what is the gap. So for example, if you're measuring women's employment in a particular country, we start by gathering data on what is the gap between female and male employment, and what specifically is the scale of the challenge. that we're trying to address, so we can actually put those metrics into context. And I think that's increasingly going to be important as well.
Thank you for that, Neil. And I want to build on that by getting a perspective, to complement the asset owner perspective and to hear from the asset manager side of things. And Veronica, can you talk a little bit about how you incorporate impact data into decision making? I think this is one of the important evolutions that we've seen over the past few years, where the initial focus used to be on reporting kind of almost on the side of the actual investment activity, kind of an after the fact kind of reporting out to stakeholders. And we've seen that actually move to kind of the center of decision making as well, where that data is actually really being focused on by investors to help them think about how they manage their portfolio. Can you talk about what your experience has been with that in practice?
Yeah, absolutely. I mean, we think this is crucial. In fact, I think whatever we don't measure and we don't monitor, I mean, it's not really a real target or a real intent. So impact targets, as well as other things that we of course do, because we seek both financial and impact returns, need to be made before the investment is made, during the investments, and also at exit. So before the investment is made, so we have to look at it and try and quantify what's the impact potential of these particular investments. And this is why our scorecard really focuses on the investment itself, and the ESG scorecard on the company, because we could invest with two different funds that have two different intents. One can try and build on more education finance, for example, and another one wants to increase on climate insurance. But so the potential outreach for each investment in that particular institution might be different. Also, if you don't set a target at the beginning, what do you measure against? So this is also important for us, at least on a yearly basis, to see if the original targets are being met or not. If there are issues, I mean, it's an opportunity as well to engage, to understand better what happened and what can we do to assess this. So also on our impact scorecard, we measure the risks of not achieving that impact. And so it's also another way to see, okay, what happened and how can we try to make sure that this doesn't happen again in the future.
Wonderful, thank you. And I want to transition to talking about how we think about climate impact and also intersectionality. This is an incredibly dynamic time where, of course, we see the visceral effects of the climate crisis. We also see increasing leadership from a number of investors and corporate leaders, particularly around the frame of net zero operations and portfolios. This has brought more kind of scrutiny and interest around kind of climate impact metrics. And recently, Ceres and the GIN have been collaborating on an initiative to help develop the climate change mitigation theme within the IRIS Plus framework. That will be going live soon, and I hope that every climate conscious investor will make use of it. And I also hope that every investor is a climate conscious investor. But I'd love to hear kind of what that is looking like in practice when we think about climate impact metrics. And Amanda, can you talk a little bit about what's been helpful to date and where there's still challenges? And I'd also like to add in the dimension of how do you look at the intersection between climate impact measurement and management and other real important issues like racial equity and the just transition as you think about the climate impact analysis of your investments?
Yeah, it's hugely important, as you said, and I think it's an emerging space. And so I think we've done a ton of work versus we're thinking about right now our existing portfolio, really understanding the data that exists today, both on our transition risk and our how do we actually help our portfolio transition to that? How do we measure and understand and manage that transition and climate risk? And also the physical risk, again, because we have such a large real estate and real asset portfolio, understanding actually what is the immediate and sort of imminent potential risk that exists for our existing portfolio, both measuring that, integrating that into our analysis. How do we help our investment teams actually understand that is a big part of what we've been working with and trying to get good and better data. I think, again, carbon data and other data is out there, and I think there's still gaps that exist. And then the second piece actually is really around engagement. So working with companies, particularly in our public equities portfolios, to push them actually towards some of these existing best practices, push them towards and ask them to continue to engage around best practices of disclosure and setting science-based targets, and actually saying, you've got someone in your corner, you have Nuveen in your corner who's actually hoping and helping you get to that place. I think things like the TCFD have been hugely important. I think increasingly actually seeing folks who are setting net zero targets has been encouraging. I think it's both encouraging for our portfolios and for us as an organization as we think about what we can continue to do in this space. But there's still certainly a lot of room to go.
Great, thank you. And we're running low on time, so but I'll try to squeeze a couple more questions in here. Veronica, I'd love to get your perspective on the same question. How are you seeing climate impact metrics factor into your work? And how do you see it evolve around questions around intersectionality?
Yeah, so for us, I mean, as an impact fund manager, we have both environmental and social sustainability, objectives on our mission, but we think they're linked, of course. I mean, with climate change, I think this is a threat as well to also meet our social objectives. I mean, losses, from climate-related catastrophes really disproportionately affect the poor and vulnerable. They disproportionately affect women. So all our funds that are, targeting gender or poverty, etc., would be affected with negative climate change. And the solution that we see is really increasing climate finance, and the needs are huge. So we really need to step up. We think that this is the work of the public and the private sectors. If not, we're not going to make it to reach our targets on the Paris Agreement targets. And we think really that we need very, very strong measurement frameworks on climate, on everything else, but on climate it's really crucial. We have seen investments in sustainable finance tripled over the last 3 years. Only in Switzerland, I think in 2019 they increased 60%. And there's not really, there's a perverse incentive to classify everything as sustainable or as a green fund, and there's little let's say audit or verification from a third party to check if this is really a green fund or not. And we need transparency to improve these and to reach our levels. In Europe, there are two really big important changes in regulation to tackle this. I think the time will not allow me to explain that, but I would invite to review the EU action plan on the taxonomy that has really a framework that will help define what economic activities can be classified as sustainable. And also the second piece of regulatory change is the Sustainable Finance Disclosure Regulation that will very much define what ESG related disclosures stakeholders will need to make.
Thank you for that, Veronica. And just to close, I'll ask a couple of lightning questions to Neil and Amanda, building on that last point that you made about things that are on the horizon that you think will really have a dramatic influence on the space. So I'll start with Neil and then to Amanda. What are you most excited about over the next year that will drive much needed progress in the impact measurement space?
I think what's been exciting this year, and what's been a very difficult way in many ways, is to see the way that investors have embraced the idea of social bonds going beyond the green bonds, and particularly bonds that are focused on COVID recovery. We're working on several structures to mobilize capital for that, and I think that will be a trend you'll see over the next year. Is that there's so many angles to the recovery, the social impacts, the health impacts, and building back greener, as everybody's talking about. And I think there's opportunity to mobilize capital by having clear structures and clear measurements of our impacts in all those dimensions.
Wonderful, thank you. And Amanda, if I can ask you in 30 seconds, can you talk about what you're most excited about?
Yeah, I'm excited about the convergence, hopefully, and collaboration that's happening between standard setters, methodology makers. I think there's a lot of opportunity there, and I think that's both what investors and corporations are really looking for. So I'm stoked about standards this year.
Well, lovely, and I think that's a perfect note to finish on about where we're going. As we close out this wonderful panel, ultimately, the world is facing many just critical crises, and as we try to mobilize more capital to help rise the challenge of the climate crisis, It's also important for us to remember we don't just need capital at scale, we need impact at scale. And all the important work that you've heard of from our panelists are helping to bring the integrity to that capital to make sure we're actually getting the results that we need to support an inclusive society and a healthy planet. Thank you all for joining us.